Hey, beautiful people. Thank you for coming back and checking out our channel, Invested. We're looking at a question, and it's a good question. It's something about non-recourse and recourse debt. Well, we'll elaborate that. Let me read the question. What do lenders look for when considering a non-recourse loan? I have about 6 commercial real estate properties now. All have strong DSCR and cash flow. DSCR is debt service coverage ratio and cash flow. At what point when acquiring future assets do I stand firm on a non-recourse loan? I guess I'm looking to be educated from any lender out there on what they look for when considering a non-recourse loan. Thank you. Good question. And a lot of people may not even know what a non-recourse debt is or recourse debt. So think of it, non-recourse meaning that, look, all the news you hear about Blackstone, BlackRock, Brookfield, they have a building that was worth $500 million and building price went down. So they just gave the key back to the lender. That's called a non-recourse debt. So what that means is the lender's not going to come back to you personally to guarantee that loan. So essentially the collateral, which in this case, the real estate, the commercial real estate, CRE, is the collateral. And of course, there's a lot of multiple facets how the lenders underwrite to ensure there's non-recourse or recourse debt. So as an example, if I have a W-2 job and let's say I'm moving up and being smart and frugal and I want to buy a real estate, right? So I go and try to get a lender saying, hey, I really like this property. I can put down, $500,000. The property's worth $1 million, and can I get a loan for $500,000? And they'll say, oh, great, great, Charles. I'd love to help you with that. We'll take a look. Do you have any, information pertaining to the asset? Blah, 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 and fill out a credit form. But I have nothing, right? I'm just starting it out. That doesn't mean I'm not going to become big or be successful. But at that moment, you really don't have any assets that the banks feel comfortable giving you a non-recourse debt. You may have your stock account. Maybe you own your house, right? But you want to buy a commercial real estate. Then those are not going to be non-recourse. These will be recourse, meaning that you're going to be personally liable. You're going to be signing that under your personal name. So something would happen that can come after you. That's what a recourse debt is. So this individual is talking about a non-recourse debt. So usually, traditional lenders or all these people will take a look at if you're financially strong enough to have a non-recourse debt. So there's multiple things that they're going to be looking for. Number one, if it's a real estate transaction, they're going to look at the market. They're going to look at appraisal value. So as an example, this building is being sold for $1 million and the appraisal comes out to be $1.2 million, right? So the collateral is stronger from a third party. And also I use $500,000 as an example because now the lender's only going to give you 50% leverage. You come up with $500,000, which is equity, cash, and the lender's going to give you $500,000, makes $1 million. So depending on the cash flow of the business or the real estate, if it could be multifamily, retail, whatever it may be, the $500,000, depending on whatever the interest rate is, do you have enough to cover that plus some? That's where this individual talks about DSCR, debt service coverage ratio. And most lenders are going to have something called 1.2 to 1.3. I've seen it as high as 1.5 DSCR. What that means is your net operating income has to be 150% of your debt service. 1.2 means 120% of your debt service. So that's what they're looking for. So the stronger the cash flow, the lower the borrowing leverage, and how much money you have as an individual or a corporation or entity, that's going to all factor in because all these lenders have to go to their IC, investment committee, get approval. So if you have 6 commercial real estate property, and let me just throw out hypotheticals here, and they're all worth $1 million. So you have $6 million of AUM, asset under management or value. That doesn't mean you own it all cash. Maybe you have leverage on those, right? So let's just say 50. So now you're worth $3 million. So then you go to buy a property that's $1 million again, and you're going to put up $500,000. Yeah, then you can definitely ask for non-recourse because you have strong credit. You have the financial P&Ls to support that. Hey, I can pay this over to you guys 3-4 times over. And also this property is self-performing and it's doing like 1.8 DSCR or even 2. So you're pretty secure from a collateral perspective. And I do not want to have a recourse debt. That's very reasonable. Lender may not. It's up to their discretion and their IC. But at that point, yeah, they can do that. The other aspect of it is again, $3 million worth of equity because you have 6 property worth $6 million. You want to go buy a $30 million property and you're going to take 65, 70%. Yeah, they're going to have a recourse on that. So it's all relative. We do want to get to where it's non-recourse debt, but also you got to understand sometimes when having a recourse debt, even though you're financially strong, your rates might differ. So what I've seen in the past is, just using this as a hypothetical example, if you have a non-recourse debt and just like, yeah, we'll give you a non-recourse, but the interest rate's going to be 5.5. But if you had a recourse debt, your interest rate might be 4.95, right? So what's better? So that's something you have to also weigh on to see what it is. So the lower the leverage on the asset, meaning that you borrow less against it, you have more, your skin in the game, right? The bigger the equity check, less loan, the lender's going to feel a little bit more secure because I was like, oh, this guy has like 60% of his money in there. We're letting him borrow 40% and the asset is strong, right? And also another thing they will look at is your past history. So if you're a first-time CRE investor, you really don't have a track record, right? You could say, I did a couple of Airbnb, a couple of single-family home, but they're not really like a commercial level. But if you have 6 commercial real estate property and all happen to be multifamily and you're performing really well and you got to buy a little bit larger multifamily and your track record shows that you're a great operator, now that's going to give a little bit more confidence to the lender too. So then those are the things that you will need to underwrite. The lenders have to underwrite you or your entity and kind of unveil that entity and see who you are. That also has a factor. And this is a little bit more elaborate, but even though we get a non-recourse loan, there's something called a bad boy clauses. That's going to be a caveat. Where, I mean, bad boy clause, just like the word bad boy. And let me just tell you one other thing. Real estate, we are the most non-creative people in the world, right? So bad boy means that you did a bad boy act. So it means that you did fraud, you providing information knowingly, and all those things, then you're going to have recourse. So those are called the bad boy carve-outs. So you're always going to see that. So those are the things that you have to be mindful. And I think you're doing a really good job. If you have, I don't know how old you are or whatnot, but 6 commercial real estate property, big or small, you're going to the right tracks. And as you systematically add that to your portfolio and you get larger, and you'll get to a point where, lender's going to feel comfortable with you and you'll non-recourse debt. And my advice to you is there's going to be lenders out there that give you a chance and you want to keep building that relationship with the lender, right? So it doesn't have to be Bank of America. You're just a small little club. But if it was a regional credit union or if it was a regional bank, you're building 6 portfolios with them and they know your history, they're going to be a lot more favorable with you as well, too. And I hope this information was helpful. And if you liked our content, please leave comments, share, and follow us. Thank you very much.